Portugal has long been one of Europe's most attractive destinations for expats, for good reasons. Sun-soaked coastlines, vibrant cities, and a relatively affordable cost of living continue to draw professionals, retirees, and entrepreneurs from around the globe. There is another reason why Portugal is on the radar of so many newcomers: its expat-friendly tax regime. While not entirely tax-free, the system does offer incentives and planning opportunities that can make life there financially rewarding. Of course, if you know the rules. This guide walks you through the essentials of the Portuguese tax system for expats. I'll be covering residency rules, income tax, property and capital gain tax, as well as the end of the well-known non-habitual resident scheme and its successor. First things first though, determining your residency status. The first step in understanding your tax obligations in Portugal is figuring out whether you qualify as a Portuguese tax resident or not. Broadly speaking, you are considered to be a tax resident if you spend 183 or more days in Portugal in any 12-month periods, or if you maintain a permanent home in Portugal as of December 31st of the relevant tax year, so that would be 2025 in this case. Additional conditions apply, of course, for individuals working for the Portuguese state abroad, those serving on Portuguese flagged ships or planes, or if the head of your household is already a Portuguese tax resident. Importantly, once you qualify under any of these rules, you are generally considered a tax resident for the full year in Portugal. This is important because residents are taxed on their worldwide income through that year. Non-residents are taxed only on Portugal-sourced income. Now I'll be discussing the income tax for residents. Portuguese income tax, also known as IRS, is progressive, meaning the higher your income, the higher your rate. For 2025, the lower rate ranged from 13% to 48%, with an added solidarity charge of 2.5% on income above 80k and 5% above 250k euros. Employment and self-employment, investment income, dividend, interests, rental income, and all other incomes are also taxed. Couples in Portugal may choose joint filing with combined income taxed on the same progressive scale. Capital gains and investment income in Portugal. Expats planning to invest or sell assets in Portugal should be aware of the capital gain rules. Real estate. Only 50% of the gain is taxable for residents, and it's added to your other income and taxed at the progressive tax rates mentioned earlier, so 13 to 48%. Shares and securities. They are typically taxed at a flat 28%, although you may elect to include them in your IRS return if progressive return rates are more advantageous for you. Key exemptions include proceeds reinvested in another primary residence within the EU or EEA, subject to timing rules, assets acquired before 1989, these are fully exempt, and reinvestment into pension or life insurance products by those who have reached the age of 65 or older. And dividends and interest are also taxed at 28%, but residents again can opt to include them in their personal income tax filing. Depending on your total income, this may lower your total tax liability. I'll also talk about property ownership and rental income now. If you own property in Portugal, you'll be paying EMI, the municipality property tax. Rates vary by location, and it goes from 0.3% to 0.45% of the taxable value of the house. Rural properties is fixed at 0.8%. High value properties could attract an AIME surcharge starting at 0.7% on total holdings above 600k for individuals. Rental income falls under the IRS, and the standard progressive rates apply after allowable expenses. Preferential flat rates may apply, including just 5% for long-term residential leases over 20%, and this makes Portugal an attractive market for landlords. Inheritance and gifts. Portugal abolished traditional inheritance tax in 2004, but stamp duty of 10% still applies to inherited or gifted assets located in Portugal when transferred outside the immediate family. Transfer between spouses, children, and parents remain exempt. Corporate and business tax. For expats running a business in Portugal, corporate tax is set at 21%, with reduced rates for small and medium-sized enterprises. VAT applies once turnover exceeds 12,500, with rates of 6, 13, and 23% depending on the types of goods sold or services rendered. Entrepreneurs can also benefit from the simplified regime for smaller operations. Non-residents are taxed only on income sourced in Portugal, typically at flat rates. Employment income at 25%, rental income 10 to 28% depending on the lease type as mentioned earlier, pension income at a flat 25%, dividend and interest at a flat 28%, capital gains 28%, and as mentioned before, some exemptions are available on the capital gains tax. Double taxation treaties play an important role here, as they can reduce withholding taxes on investment income. An important note to make here is that the NHR regime has ended. It was once a major drawing for expats, and it officially closed to new applicants on January 1st, 2024. Those who enrolled before that date continue enjoying its benefits, including a 20% flat rate on high value Portuguese income and exemption on foreign income for up to 10 years. As a successor, Portugal introduced a tax incentive scheme for scientific research and innovation, IFICE. This is a more targeted, offering a 20% flat rate on eligible income. There are some long-term alternatives, which is basically planning past the NHR. For many expats, the end of the NHR regime raised the question, what's next? One option is the Apex Portugal investment structure, a life insurance-based arrangement that allows for long-term tax efficiency, particularly after the NHR regime ends. Under certain conditions, expats may achieve effective tax rates as low as 11.2% on income and gains after 8 years. Such solutions highlight the importance of forward planning. Expats without forward planning may suddenly face one of Europe's highest top tax rates once the special tax rate expires. So here are the key takeaways for expats. Portugal is not tax-free, but with the right planning, it can be very tax efficient. Your residency status determines whether you are taxed on global income or only on your local Portuguese income. Income for capital gains, property, and inheritance all have specific rules, often with good exemptions, and it's always good to be in touch for those exemptions. While the NHR regime is no longer open, those who already enrolled will be able to continue to benefit from the special regime. The new expats from 1st of January 2024 will qualify for the new tax structure or alternative structure like Apex Portugal. The final thoughts of me on this video is that living in Portugal offers enormous lifestyle rewards, and expats should in this case not underestimate the complexity of Portuguese tax system. Filing obligations and progressive income tax rates and shifting rules like the end of the NHR regime makes careful planning important, and with understanding the framework and working with Portuguese, or me, and international tax lawyers, expats can enjoy life in Portugal without unpleasant surprises from the tax office.